A recession is a period of economic decline. It happens when a country's economy shrinks. This is measured by a drop in the gross domestic product, or GDP. Recessions are marked by job losses, business closures, and less consumer spending. They can be mild or severe and last for months or years. Causes are complex, like sudden shocks or debt buildup. Governments, businesses, and individuals can take steps to cushion the blow. Recessions are a normal part of the economic cycle. Learning from past recessions helps build resilient economies. One major cause of recessions is a demand shock. This happens when there's a sudden and significant drop in spending. Consumers lose confidence in the economy. They might worry about their jobs or the future. This fear can lead them to cut back on spending. Businesses also play a role in demand shocks. If companies see a decline in sales, they might reduce their investments. They could postpone expansion plans or even lay off workers. This reduction in business spending further weakens demand. The impact of a demand shock can be severe. When people spend less, businesses suffer. This can lead to a downward spiral with more job losses and further reductions in spending. Breaking out of this cycle requires restoring consumer and business confidence. This often involves government intervention. Governments can increase spending or cut taxes to boost demand and stimulate the economy. They can also provide support to struggling businesses and individuals. Another culprit behind recessions is a supply shock. This occurs when something disrupts the production and supply of goods and services. Imagine a natural disaster that severely damages factories and infrastructure. This disruption can lead to shortages of essential goods and raw materials. Supply shocks can also be caused by sudden price spikes in essential commodities like oil. A sharp increase in oil prices can ripple through the economy, affecting transportation costs, manufacturing, and consumer prices. This can lead to inflation and reduce economic activity. The consequences of a supply shock can be far-reaching. Shortages and price hikes can hurt businesses and consumers alike. They can lead to reduced production, job losses, and a decline in overall economic output. Addressing supply shocks often requires a combination of strategies. Governments might release strategic reserves, provide subsidies to affected industries, or invest in alternative sources of supply. Businesses may need to adjust their production processes and supply chains to adapt to the new reality. Central banks play a crucial role in managing the economy. They control interest rates and the money supply. However, mistakes in monetary policy can contribute to recessions. If a central bank raises interest rates too quickly or aggressively, it can stifle borrowing and investment. High interest rates make it more expensive for businesses to borrow money for expansion. They also discourage consumers from taking out loans for big purchases like houses or cars. This can slow down economic activity and lead to a recession. On the other hand, keeping interest rates too low for too long can create other problems. It can fuel asset bubbles where the prices of assets like stocks or real estate become unsustainable. When these bubbles burst, they can trigger a recession. Finding the right balance in monetary policy is a delicate act. Central banks need to carefully assess economic conditions and adjust interest rates gradually to maintain stability and avoid triggering a recession. Section 5. Fiscal policy, taxing and spending. Governments influence the economy through fiscal policy, involving taxes and spending. Missteps in fiscal policy can contribute to recessions. High taxes or drastic spending cuts can slow economic growth. Imagine a government facing a large budget deficit. Austerity measures can backfire if they go too far. High taxes and low spending reduce money for spending and investment. This weakens demand and can trigger a recession. Governments need to balance fiscal responsibility and economic growth. During a recession, increased spending or tax cuts can stimulate demand. This helps create jobs, boost confidence, and promote recovery. Section 6. External shocks, ripples from abroad. In today's interconnected world, economies are not immune to events happening in other countries. External shocks, such as a global financial crisis or a recession in a major trading partner, can have significant ripple effects. For example, if a country relies heavily on exports and its main trading partner enters a recession, demand for its goods and services will likely decline. This can lead to job losses in the export sector and a slowdown in economic growth. Similarly, a global financial crisis can disrupt credit markets and reduce investment worldwide. This can have a cascading effect, hurting businesses, leading to job losses, and potentially triggering a global recession. Managing the impact of external shocks requires international cooperation. Countries need to work together to coordinate their economic policies and provide support to each other during times of crisis. Section 7. Responding to a recession. When a recession hits, governments and central banks use various policies to mitigate the downturn. These include monetary policy, fiscal policy, and other measures. Central banks may lower interest rates and engage in quantitative easing. Governments may increase spending and cut taxes to boost demand. Additional measures include financial assistance and regulatory reforms. Section 8. Weathering the storm together. Recessions are a complex and challenging phenomenon, but understanding their causes, effects, and potential responses is crucial for mitigating their impact and promoting economic recovery. While recessions can be triggered by a variety of factors, from sudden shocks to policy missteps, they often share common characteristics such as declining economic output, job losses, and reduced consumer spending. Effectively responding to recessions requires a multifaceted approach involving a combination of monetary policy, fiscal policy, and other measures tailored to the specific circumstances. International cooperation is also essential for addressing global economic challenges and mitigating the spillover effects of recessions. By learning from past recessions and working together to implement sound economic policies, we can strive to create more resilient economies that are better equipped to weather economic storms and promote sustainable growth. While recessions are disruptive and painful, they can also serve as opportunities to address underlying economic weaknesses and build a stronger foundation for the future.